In today's video, we're breaking down 6 specific stocks analysts and institutional investors have been warning about as we approach the end of the year. These companies aren't necessarily bad, but they're facing real headwinds, declining fundamentals, rising debt costs, competitive pressure, or valuations that simply don't match the current earnings environment. If you're reviewing your portfolio before year-end, these are stocks worth taking a closer look at. Let's start with Macy's, a company that continues to struggle despite major restructuring efforts. While Macy's has pockets of digital strength, the core brick-and-mortar business is still dealing with declining foot traffic and heavy competition from discount retailers and online platforms. Margins are tightening, inventory levels have been difficult to manage, and the company carries meaningful debt, an issue in a high-rate environment. The macro picture is also unfavorable. U.S. consumers are shifting toward essentials and value shopping, leaving traditional department stores squeezed. Many analysts believe Macy's has years of challenges ahead before meaningful growth returns. Next is Peloton, PTON, a stock once loved by growth investors but now facing severe structural problems. Revenues have fallen significantly from pandemic highs, user engagement is mixed, and churn on subscriptions remains a challenge. The company has tried hardware leasing, partnerships, and content expansions, but none have restored profitability or consistent user growth. Peloton also carries substantial long-term debt, which becomes more dangerous in a tighter credit environment. While the brand remains recognizable, the financials suggest an uphill battle that investors should watch closely. Another stock raising concerns is Lucid Group, LCID. The EV sector as a whole has cooled, but Lucid faces some of the toughest obstacles. The company burns through cash at a rapid pace, production numbers fall below expectations, and demand for luxury EVs has softened more than anticipated. Lucid's vehicles are technically impressive, but the price point is too high for mass adoption, and margins remain deeply negative. With competitors like Tesla, Rivian, and legacy automakers lowering prices, Lucid is caught between rising competition and limited scale. The risk of further dilution remains high, making it an increasingly speculative play. On the financial side, a stock many analysts place on their sell or avoid list is New York Community Bancorp, NYCB. Regional banks have been under pressure due to rising defaults and refinancing issues in commercial real estate, especially office buildings. NYCB has been hit harder than most, posting large write-downs and showing signs that more losses may still be ahead. The CRE market, especially in large metro areas, remains stressed with high vacancy rates and falling property values. Any regional bank with heavy exposure to this segment is carrying elevated risk, and NYCB is at the center of that storm. Even a stabilization in rates may not be enough to offset the deeper structural challenges the bank faces. Another name to watch is Paramount Global, Para. Streaming competition has become brutal, and Paramount is losing ground to giants like Netflix, Disney, and Amazon. While Paramount Plus has grown subscribers, the platform still operates at a loss, and cord cutting continues to hurt the company's core TV business. Advertising revenue is inconsistent, cash flow is under pressure, and the company is exploring potential asset sales or partnerships just to stabilize operations. Investors looking for stable media exposure may find better alternatives, as Paramount's turnaround path remains uncertain. Finally, we have 3M, a dividend giant that has become what analysts call a dividend trap. The stock's yield has risen not because of dividend growth, but because the share price has dropped significantly over the past few years. 3M faces ongoing legal liabilities, slowing revenue growth, and pressure on margins. While the company is attempting to restructure and spin off certain segments, these moves may take years to fully materialize. Dividend cuts remain a possibility, and the long-term fundamental picture is still cloudy. These 6 stocks, Macy's, Peloton, Lucid, New York Community Bancorp, Paramount, and 3M, Each face unique challenges, but the underlying theme is the same: structural issues that may not resolve quickly. As the year comes to a close, investors should take a closer look at their portfolios and decide whether these companies still align with their long-term strategy and risk tolerance. Year-end is an ideal time to reduce exposure to stocks with rising uncertainty, harvest tax losses, and reallocate into stronger long-term opportunities.